Stocks slip further after a weak session in the US on Friday. IT and energy are the big drags, even as metals and consumer durables eke out some gains.
Stocks of city gas distributors slump after nodal agency GAIL cuts gas allocation by 20%. This is expected to lead to significantly higher gas sourcing costs for distributors.
The Honasa consumer stock slips below its IPO price after a decline in sales leads to losses in the September quarter. The disruption following its distribution model change is the key factor behind the weak show, along with weakness in the mother brand Mamaearth.
And China's move to withdraw the tax rebate on exports of aluminum and copper from the 1st of December boosts the prices of metals and powers up stocks of Indian aluminum majors Nalco, Vedanta and Hindalco as well. Good afternoon, you're watching Halftime Report here on CNBC-TV18. I'm Hormas Fatakia, with me is Mangalam Malu in what has been a very volatile start to another truncated week that lies in front of us. The Nifty now recovering from the lows of the day, but the question is, will that recovery sustain? And every small recovery has been sold into so far as we speak. Nearing levels of 23,450 now is the index. The leading the way down is the IT index, and the Nifty Bank is the one that is holding on to some bit of support and aiding some recovery for the index. Mangalam, good afternoon.
Good afternoon. Good afternoon. We're seeing some recovery for the markets. Let's see where it goes from here. Nifty Bank, of course, is holding one end up for the market. The good part is that some of these IT stocks, which were actually seeing a bit of a sell-off, are now coming off lows as well. So at one point, Infosys was down nearly 4%. And currently, as we speak, Infosys is down about 3.2%. Pull up something like a TCS as well. We're seeing some bit of recovery from the lows. If the IT stocks were to recover, then maybe, there would be a twin engine firing for the Nifty, and that would lead to a bigger recovery. The other thing we need to look at is Reliance as well. Reliance at one point was lower by almost 2% and now has recovered about 1.01% from the lows itself. Yes, still in the red, but as you can see, the chart has pointed towards some sort of recovery, and with its high weight on the index, if Reliance was to also lead from the front, we would see some bit of recovery. So we're down and we are below the 200-day moving average. After a very long time, the markets stayed below the 200-day moving average for a significant amount of period of time. So it needs to cross past those levels first up to actually show signs of further recovery. We'll keep an eye out on all of that. But amidst all of that, we do have a bunch of results we need to take note of. Anupam Rasayan is the first management that joins us on the show today. The company witnessed sequential improvement in the second quarter, but earnings year on year, if you compare it to it, looks a little weak. But the important part is what happens from here on, where the company expects the volumes from agrochemical space to improve gradually in the second half. Vishal Thakkar, the Deputy CFO of the company, joins in now. Thanks a lot, Vishal, for joining in. Before talking about, business demand and pricing, let's talk about working capital. I'm looking at your numbers, and the working capital is nearly 600 days. That's almost 2 years. You've been talking about bringing it down to levels of 220 days or so. What is leading to such a big surge? What's your receivables picture like right now? Because that's one point of contention that investors have, and they're really beginning to get concerned about it.
Mangalam, thank you. Thank you for getting us on your channel. And yes, what concerns you have raised is a concern that we as a management also have, and fairly so. I think if you look at the working capital, you have to divide it in two different parts, and that's where the challenge is, if you really look at it. One is that because my sales are lower, my ability to unwind the working capital is lower. Also, when the sales are slower, the customers will be paying on a lower on a longer term, and they request us for that. These are all the customers that we have been doing business with over the last 5, 10, 15 years, and we need to work with them during this kind of a downturn, where we have been supporting them, and that's where the days have expanded. Days expansion has happened, as I said. Working capital ability to reduce the working capital has been lower, and two is also because my sales are lower, the number of days look even further. So it's a numerator and denominator both there. If you look at it, we believe that the next year, which as you rightly identified, that my Q-on-Q growth has been there, YOY has not been there, but we believe that the H2 will be far better than the H1. And we believe that FY26 should be back to a good growth time frame, growth journey that we have seen historically. Once we see that, you will see that these all working capital will easily come come back to a more normalcy period that we would have seen, especially if you really look at it, like my 22 versus 23. If you look at it, my 22 was a very weak year in terms of working capital, which had improved in 2023. Unfortunately, 24-25 is a period where we have seen very significant level of headwinds, especially in the agrochem cycle, which is the key reason that you see that these numbers are not in line with what we would expect assets to be at.
Vishal, good afternoon. Thank you for joining in. Have you put a number to that improvement? You're mentioning that the second half would be better than the first, but do you expect this number to trend down to say 400 days or maybe even 300 days by the time you finish FY25?
So see, I will tell you two things. So if you ask me on the 25 numbers, 25 numbers should look like similar to the 2024 numbers. So we should be looking at a similar kind of a range that is there. So the numbers that you were speaking, probably that's where we would be. That's what we are targeting for the first phase. Second phase, if you look at it, I am expecting a significant growth in 26. So when my growth comes in 26 is where I would go back to the numbers like what we were speaking about 250, 260 days. The kind of numbers that we have been seeing in 23 is what you will see in 26 is what we are planning for. That's a broad plan on the working capital side. On the revenue side also, if you look at it, it's a similar approach that H2 will give the growth, which will ensure that my FY25 and FY24 are in similar range. And 26 is where I grow significantly, maybe 25-30% and above, which will then give me a room for liquidation of working capital, as well as also my base number will be better.
All right. Let's talk about the second half for the overall business on the whole. You continue to guide between 26 to 28% sort of margins. And in the first half, you've done just about 24%. So that tells you that the room for improvement in the second half is significant. And also the first half, your revenues are down 30%, your EBITDA is down 36%, net profit is nearly halved. By the end of this year, if we were to look at your overall performance, where do you think the revenue would be, the EBITDA margin? You've given us a band, and the net profit. How does that compare to all of FY24?
So, okay, let me start with the margins first, which is the EBITDA margins. My EBITDA margins are, as I was mentioning, it will be the 25 to 27% band, which have been historically, because mind you, 26 to 28, I used to guide when we were only talking about the standalone side. When we look at the console, the TANFAC numbers also come in, and that's the reason I am guiding in the range of 25 to 27%. And that we believe that should be achievable as we go, right? That's one part of it. Now, let's say on the second part of the PAT side, PAT is a clear translation from my my depreciation and interest, which will translate into that. Depreciation is in the range of around about 80 odd crores, and that 85 crores. So that will be translation. In terms of revenue, that's as I was saying, that the kind of demand that now we are seeing, especially from my customers on the agro side, we believe that the agro demand is now picking up. Pharma anyways have picked up. Pharma is continuing to grow. Last year we launched a significant number of new molecules in the pharma side, which has now started giving me revenue, and it is ramping up. So pharma today is contributing around about 20% of my revenue, which historically used to be 2-4%. So that's again the growth that I'm seeing. So end in end, I should be ending up around the 24 number in 25, maybe plus or minus 5 percentage point is what I would put it at as of now.
Right. Very quickly, Vishal, due to paucity of time, just squeezing in one last question. Your LOIs have been increasing significantly, but are they converting to revenues? Because for FY22, you were at 2,600, FY23 was 1,000. How much have you added via LOIs in FY25? And what's the conversion timeline, if you could share that with us as well?
Lovely. So see, LOIs typically are 2 plus 2 plus 2, as I say. So 2 years to get to the LOI, 2 years from LOI to commercialization, and 2 to 3 years from commercialization to ramp up to the full capacity. Now let's look at in 2022, I had done 2,600 crores of LOIs, that what you mentioned. So typically, if I divide it by 5 to 6 years, which is an average time period, we are talking 450 to 500 crores of revenue. I am looking at last year we did a revenue from about 200 and plus from the LOIs and all. We expect this year to be also 200 to 250 kind of a number, which means I have gone to 50% of the revenue that I would expect from these kind of LOIs of 2022. And now next year onwards, I will start commercializing the 23 and 24 also, which will further give me the growth.
All right, we take that point. Thank you so much for joining in and giving us your details. We'll obviously look forward to you ending this year with a difference of just 5% versus last year's revenue, and that will indicate a strong second half of this year as against what has happened in the first half. And we'll await your margins being between 25 to 26% as well. Wish you good luck for the remainder of this year. With that, we'll take a short break. On that note, also give you some programming updates. The 11th SBI Banking and Economics Conclave will go underway this afternoon. You can catch Finance Minister Nirmala Sitharaman addressing the gathering at 2:45 p.m. today. Other guests of honor include the likes of Finance Secretary M. Nagaraju, Revenue Secretary Sanjay Malhotra, Chief Economic Advisor Anant Nageshwaran, and also the IRDAI Chairperson. We have Debashish Panda and ex-SEBI Chairman M. Damodran. You can catch exclusive coverage of this entire event only on CNBC TV18.
Welcome back. Now, what is good for India is good for HUL, according to its MD and CEO Rohit Java. Now, on the sidelines of CNBC TV18's Global Leadership Summit, he also spoke about the current consumption trends. Listen in to what he had to say.
We've been here for 90 years, and the mission with which this company was born and led right from early days by Indian leaders is what's good for India is good for HUL. And recently, when our global CEO, Heinz Schumacher, was here, what's good for India is good for HUL, is good for Unilever. Because basically now we are almost 13-14% of Unilever globally. We are a hub of not just a scale of business and opportunity, with huge headspace, as we've spoken about the India story, but importantly, we're also a hub of talent, R&D, science and technology, and innovations. When we look at we look back 10 years and look forward 10 years and look at neighboring markets, and I've said this before, the per capita consumption of markets like Indonesia, more like 4 times of where we are in India today, by and large, across categories. You could have the same story with Thailand, India, China. So when you compare these markets, you clearly see that there's a massive unlock that's bound to happen across categories. And because India is not one, and India is a segment of many different income stratas, you already see the categories taking off. And given the scale, we're talking a big business. So the most important thesis in a growing nation with growing prosperity and aspiration is to offer products that help people upgrade their quality of life at a price and value that suits the Indian pocket. And I think no other company can do that better than HUL, because we are in every corner of this country. We have the ability to reach our products at a very, very good cost.
Right, and that's the word coming in from HUL's Rohit Java, sticking with the consumption space itself, and this time more on the retail and, consumer discretionary space. We also had a word coming in from Nykaa's Falguni Nair, who's bullish on the retail space in India. She spoke at the Global Leadership Summit. She expressed that the next decade will be very exciting for Indian retail, and the bulk of their investment will also be in India itself. Listen in.
International is attractive, and especially GCC, where we've entered, and there could be more markets like that. However, India remains such a big opportunity that bulk of our energy and investment will continue to go in India. Actually, when we travel globally and you see the size of many of the countries and the economies, and India is a very large economy. It's just about started to take off. There are high growth rates in India and abroad. So we remain very excited about discretionary consumption in India. And I personally feel that the coming decade could be one of the best for digital and retail in India. And we, with a combination of both, bringing to the consumer through personalization and all that technology can do, we remain very excited.
Well, now for real transformation, India needs to improve ROTI, or the return on time invested. These are words coming from Uday Kotak, the founder and director of Kotak Mahindra Bank. Now, he also added that time is running out for India to become a global superpower. Listen in.
One thing for India to transform into the future, India needs to improve ROTI, R-O-T-I. Return on time invested. When we look at execution of projects in our country, anywhere. I'm not talking private sector, public sector, wherever it is. Chalta hai. Okay, approvals have taken us 6 more months. I've got labor shortage. I don't have this machine imported. The concept of time and importance of return on time invested. Therefore, India has only 23 years to go. And if you want to be a developed country with $15,000 plus per capita, this kind of roti is a tough one.
Right, it's a stellar recovery that we've seen from the lows on the markets right now. The Nifty's deficit is cut just to around 47 points. It will be very interesting to see where we go from here, and at some point do we go into the green or not as well. What is it that is taking the Nifty higher from the lows? We have the Nifty Bank, which is currently at the high point of trade. That's doing extremely well. The metals index too, sitting with a gain of almost 2.5%. For whatever its weight on the index, it's actually counting in, and we've seen the FMCG pack also come to life. So the Nifty FMCG stocks have moved to the high point of trade as well. You pull up the FMCG index, that's at the high point too. Amidst all of this, Reliance, which we were talking about, sitting with a cut of almost just 0.8%, has also reduced its deficit to 0.2%. And we have the IT stocks, which at one point were lower by almost 3% on the index, is actually recovered with a cut of just about 2.5%. So all these factors playing their part for a recovery on the index. The question is whether this recovery gets sold into, or do we see a formidable up move from here on itself. Take a short break, come back, tell you more about markets, but individual stocks as well. Honasa Consumer under pressure. Stay tuned for more details on that one.
Welcome back. Very strong recovery for the Nifty, now heading towards levels of 23,500, and the broader markets too are seeing recovery from the lows of the day. The mid-cap index has already turned green, while the small-cap index is all set to turn positive for the trading session as well. Pull up Nalco though. That stock continues to move from strength to strength. That stock is now up 12% as we speak. Benefits from the recent move announced from China, and that stock is also reflecting on the move seen in stocks like Hindalco and Vedanta. But the stock that is not doing well though, even in a recovering market, is Honasa Consumer. That is parent company of Mamaearth, and that is under pressure and is now below its IPO price after its second quarter results. Mangalam is here with the details.
Well, if you look at Honasa's, stock price, it is down 20% and locked at lower circuit with pending sell orders as well. So fair to say there is no glow for Mamaearth this time around. If you look at the stock price as well, it is below its issue price. And if you look at, the entire stock price move from its highs post-listing. Remember, same time around last year was when we saw the listing of Mamaearth. From its 52-week high, the stock is nearly halved, 45% decline after a 20% fall today as well. For those, I jog their memory, the issue price was around 324 rupees itself. What was it that led to the weakness this time around? Let's go across with the numbers itself. There was a revenue decline, EBITDA decline, as well as the net profit loss. And that was on account of two engines of the company that failed to propel this time around. One, there was disruption due to distribution model change. Remember, the company had called that out in the previous quarter itself, but this time around the number was slightly higher than what the company had anticipated. Secondly, and the bigger reason, is Mamaearth itself, the mother brand, is growing slower than expectations. So as a result of which, if you look at the reported numbers for Mamaearth, the revenues are down by almost 7%. The EBITDA from a gain of 40 crores has gone into a loss of 31 crores. And on the bottom line, the company is reporting an 18 crore loss versus a profit of 29 crores. And that has impacted some of their other parameters as well. One of the levers for margin improvement would be ad spends as a percentage of sales, but decline in revenue meant that the ad spends also have increased by almost 500 basis points as a percentage of sales, and gross margins have stayed stable at around 68-69% itself. Their other brands grew by about 30%, in the first half of this year, and they are targeting improvement out there, but other brands just account for 30% of their overall sales. The problem is Mamaearth itself. What is it that is causing the worry for Mamaearth? Now, if you go to any of your beauty stores or speak to anyone who buys a lot of these beauty products, they would know that the wave of consumer preference has moved towards active ingredient-based products and not just natural products. So you have products with niacinamide, hyaluronic acid, peptide, etc. selling on the market. market. So that's against the positioning of Mamaearth itself. Secondly, the company needs investment allocation which haven't evolved for offline-based brands. So that is something that needs a bit of a reset. And the third most important thing that we need to watch out for is the brand mix across product, price, and communication. So basically, it's time for a bit of a reset. How much time will this and the other thing take? You know, the management says that as far as the distribution is concerned, offtake scale-up of new distributors would take 2 to 3 more quarters as well. Now, this at a time when the street was paying a premium for growth for Mamaearth, which was over and above, you know, the industry, at least 2x as promised by Varun Alagh, has not come by, and now the street is resetting its expectations until the company goes ahead and does better on either of the two fronts, which is improved distribution offtake or comes up with a strategy for Mamaearth itself. Until that happens, maybe all bets are off, and that's what brokerages are saying, and that explains the weakness in Mamaearth. What will be interesting to see is whether this weakness sustains until there is improvement or not.
Will be interesting to see as well, right? We'll keep an eye out on that. Mangalam, thanks a lot for that update. A 20% circuit for Honasa Consumer on the lower side, of course, with pending sell orders, as Mangalam was highlighting. Time for a short break. Up next, we connect with Aditya Soman, the senior research analyst at CLSA, to focus on the consumer sector second quarter performance. Stay tuned. We'll be back on the other side. Welcome back to Halftime Report. Now, CLSA's recent report indicates that the second quarter of the financial year saw the biggest earnings misses in recent memory. Now, adding to that is higher inflation in some commodities and deflation in others also caused havoc. Now, to discuss this and more, we have Aditya Soman, the senior research analyst at CLSA from the 27th CLSA India Forum. Aditya, good afternoon. Thank you so much for joining in. You know, what do you make of this second quarter performance, right? Particularly from the consumption-oriented theme, a lot of these companies talking about pressures that have come in when it comes to volume growth as well. What do you make of this, and do you see an improvement coming in the second half of the year?
Hi, good afternoon, and thanks for having me on. So 3 things that I can point out from the quarter. So one, I think it's been universally called out that rural growth outpaced urban growth in the quarter. Although both were sort of slower than past trends. Now, the point I'll make here, though, is if you disaggregate urban growth, look at sort of metro cities and non-metro cities, it's very clear that the metro cities is where we are seeing a much sharper deceleration. In fact, non-metro urban India continues to grow faster than rural India. And to my mind, there are several reasons why metro cities in urban India have grown slower. One, I think we're just seeing a lot of new age companies use new platforms to distribute, platforms like quick commerce, modern retail, e-commerce, which have been growing much faster. And a lot of this data is not being captured in traditional sort of panels like Nielsen or Kantar. Secondly, we are seeing larger companies actually lose market share to smaller or mid-sized companies. Again, part of it is just distribution realignment, where the larger companies used to have a huge advantage in distribution, particularly in sort of smaller towns and rural India. But in urban, large city India, we are starting to see competition come in, which uses the platform provided by quick commerce or modern retail to expand faster. And the third is there is a little bit of a slowdown in point of sale consumption, whether it was sort of unseasonal rainfall or just city specific issues that led to slower consumption. So that's the overall view, but happy to dig into more detail.
Let's get into more details then, Aditya. You know, a bunch of companies, I don't know whether you track Honasa yet or not, so I'd like your views on that, if you at all do track that. And the second view that I'd like is your call on DMart. You have an outperform rating on DMart. So at a time when a lot of people are, looking at DMart as a sell or an underweight, largely because of the quick commerce related issues and them not growing so fast, I want you to explain your outperform call on DMart, and if at all you can comment on Honasa.
Yeah, so we don't cover Honasa at this point, but what I'll say in general is We are seeing this transition. I think it was mentioned previously that there's a transition towards more active ingredient-based plays, and that's something that's clear to see. There's also a disruption in the channel in general for a lot of FMCG companies, particularly in large cities, and that's impacting a lot of companies. So I'll leave it there, but I don't want to sort of specifically, we don't cover Honasa. On DMart, again, I mean, I cannot make company-specific comments, but the point I'll make is, yes, quick commerce is here to stay. It will be very disruptive as a channel. That being said, I think we are seeing traditional retail companies respond with a shift to private label, respond with more aggressive pricing, and that's something that you can see on the shelves today as well. So we clearly believe that there's a space for quick commerce where it offers convenience, it offers ease of use. However, when you think of large carts, large SKUs, I think there's still a place for traditional modern retail to exist and even thrive. The important point here is from a cost perspective, a lot of these traditional players still have an upper edge on cost. And over time, we might see this get disrupted. But for now, we are seeing that the cost advantage that the traditional players has persists.
What about paints, Aditya? There has been so much chatter going on about the sector as a whole, isn't it? The market leader is saying that there are challenges when it comes to demand. The newest entrant is saying that, yes, there is a slowdown, but it is not as much as some of the other players are making it out to be. What is the sense that you are picking up on the ground, and is this competitive intensity likely to cause a valuation reset for a lot of these companies, specifically for the leader?
Absolutely. So look, our view is that in markets where distribution was your sole competitive advantage, I think that's starting to get disrupted very fast, whether it's paints, whether it's FMCG. We are seeing this trend play out very clearly. In paints, our concerns are very specific, that we've got a few new entrants. There's obviously one very large new entrant, and there's several that have been around for a few quarters or years. And the environment is likely to get murkier before it gets better, in a sense that when you have new entrants making such large capital outlays, it's unlikely that they're just going to fade away without making any sort of impact on the market. And we're starting to see that, whether it's in offering higher rebates for dealers. I think that was something that was called out in the recent quarter. Whether it's seeking out those same dealers in different formats, whether it's improving their ROI through better working capital. I think all these trends will play out over the next few quarters. Now, the concern is that some companies made disproportionate ROI, and that ROI might get disrupted, at least in the short term. Now, whether this plays out over a longer term, whether the sort of leaders stay leaders over a 5-year view, our view still remains that the market leaders will stay the same over a long time. But in the next couple of years, while some of the newer entrants make their foothold, that there'll be significant disruption, particularly on ROI and margins. So that's where we see the biggest concern, not so much on sales.
All right, Aditya, final question before we let you go, and this won't be, stock specific, but there are a couple of interesting nuggets that we get from your report. The first one is that quick commerce incremental GOV has been a lot higher than incremental staple spending. That's telling you about an underlying shift in consumer behavior itself. And Zomato's incremental food delivery GOV itself was more than all the major QSR chains' revenue. So that again is telling you that, there is a significant shift in consumer preferences and spending. So the question that I'm asking you is that, just the way there was a naturals wave and the legacy companies did not benefit from that, do you think there are underlying mega trends with the current listed entities may not be able to benefit from just because they're perhaps slower on the ball, or the others have actually got the consumer sentiment right?
Yeah, no, great question. So let me answer sort of it in a little more detail. So firstly, with food delivery and QSRs, I think this is a trend we've seen now for several quarters, where the incremental sales for food delivery or the GOV of food delivery for Zomato and some of the other players has been actually much higher than the incremental sales for the QSR companies. Now, this trend is likely to stay given that competition in smaller towns enabled by the aggregators continues to improve. So now we're not saying the listed companies cannot adjust. I think think we've seen that even with naturals, as you mentioned, where eventually the listed companies readjusted their play and made the adjustment necessary to compete better. But that takes time. It takes companies to acknowledge the challenges that lie ahead, and once they do that, they typically will adjust. Our call is that in the here and now, while this adjustment takes place, there is a meaningful disruption. And it's the same with FMCG, right? I mean, even 3 quarters ago, quick commerce was seen as largely a fad. Now, more or less, people agree that it's a business that's picking up. Consumers want it. There's a clear change in mindset from a consumption perspective. And so we'll see the FMCG companies adapt to this change over time. Now, what implications that has on sales growth, what implications that has on margins and returns, I think that's where the questions lie. Our view is that the best companies will adapt to the challenge, will adapt to having more products suited to be sold on quick commerce, and eventually differentiate between the channels to provide everything for every channel. That being said, in the here and now, there will be disruption on profitability and ROI, and maybe some of them will also be forced to make acquisitions, which again could sort of bring into question some of the ROIs that they deliver. So that's the view for now. The main point being that you'll see a lot of newcomers leverage the platforms provided by quick commerce or the food delivery platforms to compete with the traditional companies which have been so dominant for so long.
All right, Aditya, we'll leave it at that. Thank you so much for sparing time and joining in. Wish you good luck for the conference ahead as well. Now, time for a short break. More on the markets and stock-specific action on the other side. We also give you an F&O wrap at midday. Stay tuned.
You're watching us on Halftime Report, and it's the perfect time to take you through the F&O setup at midday. Why do I call it the perfect time? Because the intraday chart comes in, the Nifty is just about broken into the green. So that's a stellar recovery that we've seen from the lows of today's trading session. And what's led to that recovery? We'll get to that in just a bit. But today has been a bit of a tug-of war between the Nifty Bank and the Nifty IT index. The IT index is down about 2%. At one point, it was down 3%. The Nifty Bank has been batting for the bulls. The IT stocks, which have sold off, at one point were down almost 3.5–4%, currently have recovered from the lows and still sitting with a cut of about 2.5 to 2.75% itself. What's batting for the bulls is the metals index, which is doing extremely well. By virtue of its small weight, the impact isn't as much as the 3% surge that the index would suggest. But HDFC Bank has been doing extremely well as well, with a gain of almost 1.2%. The Nifty is just below the 200-day moving average of 23,556. In fact, as we speak, is just at the 23,556 mark. So closing above that would be a big thumbs up for the bulls itself. What also will be monitored is whether the Nifty considerably stays above that 200-day moving average, and whether we see any short covering in these call writers as well. So 23,500 call writers have been fairly active. 55 lakh shares open, none of them seeing short covering, but more so the 23,400 call writers, they've been fairly active as well. And the premium out here has seen a big increase in just the last few minutes. So the Nifty stays above that 200-day moving average. Maybe these call writers will have to cover their positions, and we can brace ourselves for a bit of an up move in the second half of trade today. The 23,400 put writers fairly active, again telling you 23,350 or levels closer to today's low would be extremely crucial as a support. What are the stocks saying? Massive short build up on all these city gas distribution space. So this is one pack which is not doing well or not showing signs of recovery despite the overall recovery in the market. And then we have the metals, which is doing extremely well. So a lot of long positions added on Nalco itself, up about 12% for that stock.
Almost a 200-point recovery from the lows of the day. Mangalam, thanks a lot for that. We'll see if that sustains going into the second half of the session as well. Time for a short break. More on the markets and specific stocks on the other side. Steve.
Welcome back. You're watching us here on Halftime Report. Just pull up the intraday chart of the Nifty and you'd see that recoveries are slightly iffy right now. We're down by about 42 points. So every time we make an attempt towards the flat line, it's a good thing that we're attempting recovery from the lows, but at the same time, from the 200-day moving average, which was earlier a support, we're seeing some resistance. So the Nifty briefly crossed that 23,556 mark, and from there itself, it's seen a cut of almost 35-40 points, and that reflects in the kind of cut that we're seeing from the flat line on the Nifty itself. What is it that is, trading lower? It's more of the same, actually. We see, some weakness in the IT pack, but Britannia is one of those extremely volatile stocks. If you look at the intraday chart of Britannia, you would see that, most of today's trading session, it's been between red and green, saw an open in the gap down with a recovery from the lows. Thereafter, it was flat, tried another recovery, and that recovery has been sold into as well. What's interesting, however, is that the mid-cap index continues to do well, and alongside that, we have the Nifty Bank, which holds around that 50,350 mark. So to that extent, the second half of trade will be extremely crucial, and more so will be the advanced decline lines that come up for you on the screen as we take your leave on this edition of Halftime Report. Take a short break, come back. On the other side, we have Business Lunch taking all the market action ahead.